Hey everyone, David here. So you're new to investing or you've been around for a bit, but one thing's probably true. When you first thought about investing, your mind probably brought images of the New York Stock Exchange with everyone shouting at each other, right? Well, that's what trading can look like. It's fast-paced and can get pretty crazy. It's evolved with technology and there are still definitely people on the floor making deals and shouting tickers at each other, but you can also trade from the comfort of your own home. If you're brand new and still looking for a broker to buy your first stock, my Webull link is in the description below and you can get 2 free stocks valued up to $2,300 total when you open an account and deposit $100. Anyways, today I'm going to go over the differences between trading and investing and talk about my strategy personally when it comes to the two. Hopefully this will give you an idea of what you want to do with your money so that you can have a game plan for how much you want to put in what account. Let's take a look. Let's talk about trading first. I feel like most people who are new get fully into trading and don't do much investing right off the bat. I always see new people talking about trading and doing a whole lot of buying and selling. They finally made the leap into getting into the stock market and they immediately are driven to the gains of day, swing, or options trades. Just so you know, there are some zero risk strategies out there and most of them involve hitting the like button for me real quick. Now first off, let's get this straight. I'm not here to tell you that being a trader is bad. Plain and simple, I do trade. It's just a smaller portion of my account than I have allocated to investing. Plenty of people make good money as day or swing traders, but it's not for the faint of heart. So let's look at what making money as a trader is contingent upon. First off, a trader makes their money off of market volatility and timing. They typically make many trades in a short amount of time. They might buy and sell the same day, or they could buy and hold for a week or even a few weeks. One very important factor in trading is technical analysis. All this means is that a trader is looking for patterns within a stock price. They're using the tools that big brokers offer their clients. If you want to learn more about technical analysis basics, check out our other 2 videos covering some of the tools used by traders. Links are in the description below. Basically though, the trader looks for an entry point where they think the stock is undervalued and due to jump in the short term using trends and patterns of the price history. I've made really good money really fast on options using volatility and good timing. On the other hand, I've lost lots of money just as fast. If you're really new to the stock market, just understand that the pendulum swings in both directions. If you want to see an 80% gain on an option, you have to understand that you might take an 80% loss sometimes. The bottom line with trading is that with large reward, there's large risk. I personally only have between 5 and 10% of my entire portfolio, including my retirement, regular brokerages, and the entire value of my emergency fund allocated to trading. I personally trade because I think it's fun. I work a regular job as a project manager, and watching the market while I'm working and doing some speculation spices up my day. I also love the rush of making 120% in 2 days, but I know the risk and don't over allocate because it's not my long-term goal to become a trader. If being a trader is your goal, I'm all for it. Just know that it's going to take time and practice, and understanding the risks going into it is very important. Trading also requires a lot of discipline when it comes to your emotions. You could buy in based on solid technical signals and then sit there and wait for the reversal to come for days or weeks sometimes at a huge loss. The other thing a good trader has is a plan. You need to have an exit strategy plan and then stick to it. This includes when you're going to exit for a specific amount of loss or a specific amount of gain. You can't just ride that gain until it turns into a loss. When you're counting on market volatility and timing to make money, it's really imperative that you know when you will exit. I can't stress that enough. It's also important to know that as a trader, you're up against other traders who may not only have way more experience than you, but they might also have better tools at their disposal, like trading algorithms or specialized trading software subscriptions that they pay for. Just be aware that since there's so much money to be made in a short period of time, everyone is looking for that edge, and that can make it that much harder. One piece of advice is to take it slow and don't get excited after a few wins. Wins can cause you to overextend with more money than you should on your next trade, and it's all emotion based. This is a great way to set yourself up to get slaughtered. Trust me, I know that one from experience. So if that's trading, then what is investing? Well, there are 2 kinds of investing I want to talk about: passive investing and active investing. I personally do both of these things, but let's look at investing as a whole as compared to trading before we break it down further. Investing is a long-term practice where a trader might buy and sell hundreds of stocks in a day, trying to capture price changes and market volatility. An investor will just buy the stock and plan on making their money over 5, 10, or maybe even 40 years. Investors are concerned with how a stock or sector will perform over the long run and are counting on companies' growth over time by expanding or increasing profits year over year. With that said, what's the difference with passive and active investing? Well, with passive investing, the person may not care at all what the price of the stock or security is when they buy. An example of how I do this is my 401k at work. I have mine set up to drop certain percentages of my pay into specific mutual funds that I picked from the available selection that the 401k offers. This isn't contingent upon how high or how low that mutual fund is trading. It just happens automatically for me on payday. I have no real active role of when that position is having more money allocated to it, other than the fact that I choose how much percent goes in and which mutual fund a percentage goes into. But other than that, it's completely passive. I'm counting on my average return being impacted by time in the market and trusting that the funds I picked will increase over time. Every year, I do take a look at my allocation and reevaluate some of the funds to see if maybe I should switch some things around depending on what the markets are doing, but it's nothing really that crazy. On the other hand, my Roth IRA and brokerages lean a little bit more towards active investing. Active investing takes into account the price changes in the current market to establish new positions in long-term holds. Unlike passive investing, where you kind of just buy it no matter what's going on that day, you might be looking at trends or downturns to buy extra positions in long-term holds that you think are going to still do well overall, but you might be able to get for a cheaper price right now. The end goal of holding long doesn't change between passive and active investing. You're still looking at companies that you're going to hold for years. Active investing is still a long-term based strategy on the company growing and doing well over time. An active investor might see a company take a sudden dip based on some bad news or something weird that happened in the market. The investor personally thinks that the stock is undervalued now and decides to buy more shares at a price they believe will set them up to reap the rewards of more gains as the stock rises back to where it should be and then continues growing in the long term just like any long-term hold would. Basically, the premise is that you're looking for better than normal entry points on stocks or securities. This is how I manage my Roth IRA and regular brokerage with my long-term holds. Basically, I try to buy when I think the stock is undervalued, or I search around in different sectors for new quality stocks that might be falling victim to a short-term downtrend or some sort of news that hit that might have made the stock tumble. For me personally, I don't usually ever sell my long-term holds. Most of those holds are in retirement accounts for me, and I picked companies that I truly believe in, ride out the lows and try to buy more. Honestly, I don't really even look at my long-term holds more than once a month usually nowadays. As an active investor in those accounts, I'm more often than not looking for deals to add more positions, but once I've done my research and decided to buy, there's really no longer any point to look because I'm not gonna panic sell a long-term investment. That would be counterintuitive. I meant counterproductive. If you're interested in learning more about investments versus trades and other people's strategies, I encourage you to check out the links in the description so that you can beta test our app or join our Facebook community so that you can discuss those strategies with people who are on those platforms. Hey, who knows, you might even learn something new in one of those. You can also get into a free trial for our newsletter where you can see some short-term plays that you might be interested in if you're a trader, or you might see some good write-ups on a long-term hold that you never really knew much about, but now might be able to establish a position with better knowledge on it. If you watched the video this far, you're the real MVP. Not a lot of people make it to the end. Thanks for tuning in, and I'll see you guys next time.